Good morning or good afternoon. Thank you for having me here. We're going to drill down on cram down. One of the primary features of the bill that was passed last Thursday, Helping Families to Save Their Homes Act. It was approved by vote of the House of 234 to 191. And if it's approved by the Senate, the bill will affect dramatic changes to existing bankruptcy law. Specifically, the bill lifts a more than 15-year ban against judicial modifications of loans secured by the borrower's principal residences. Unlike almost every other secured loan to businesses and consumers, current bankruptcy law prohibits bankruptcy judges from modifying home mortgages in bankruptcy. In other words, home mortgages are uniquely accepted from bifurcation and cram down now under present law. House Bill 1106, however, will empower bankruptcy judges to do the following. First, it will empower judges to reduce, or in bankruptcy parlance, strip down. I think it's a nice article in our practice area. Strip down the principal due on home mortgages to the current market value of the home. That doesn't make any sense without sort of a very simple numerical example. Posit a note in the amount of $400,000 secured by someone's home. If the house is worth just $150,000, the proposed bill will strip down the lender's secured claim to just $150,000, the fair market value of the home. And the difference, the $250,000, will be treated like any other unsecured obligation in bankruptcy and discharged. And the lender will have a secured claim limited to the fair market value of the home at the time of the confirmation of the case. In addition, if that's not enough to give the bankers in the room a little adjective. In addition, the bill will allow judges to reduce interest rates applicable to home mortgages. And the formula that the bill contemplates is prime rate plus, quote, a reasonable premium to risk. And it's going to be determined not by the market, but by a bankruptcy judge. And lastly, the bill allows bankruptcy judges to extend the payment terms of mortgages up to 40 years, minus the period under which the loan was previously outstanding, regardless of the original term of the loan or the remaining term of the loan. There are some limitations. This is powerful medicine. This is a very strong remedy, but there are some limitations, and let me briefly sketch them, and we'll get into the meat of the presentation. The bill as passed only applies to existing mortgages, not to future mortgages. The House bill also includes a provision that allows lenders to share in any appreciation of the property value if the home is resold during the first 5 years after the judicial modification. There's not a sharing if the home is refinanced for more than the stripped down claim during the 5 years, however. In addition, to avail themselves of cram down, borrowers are required to contact their services and request loan modifications at least 30 days prior to filing for bankruptcy. That doesn't seem to be much of a barrier. What I think it's speaking to is something that the Congressional Oversight Panel spent a lot of time talking about in their report, was that borrowers who are trying to work out arrangements with loan services, not portfolio lenders like Kevin and Arthur, but third-party services, have a horrible time getting people on the phone to talk about modification of their loans. There's no one there picking up the phone. And this is sort of reflective of that. And then finally, the House bill requires bankruptcy judges to use Federal Housing Administration appraisal guidelines and to deny modifications to homeowners who can afford their payments but are simply underwater. So those are very briefly, in broad outlines, the caveats that apply to the new cram down power applicable to home mortgages. Even with these limitations, however, this is arguably the most significant change to the Bankruptcy Code since its enactment in 1978. It's certainly the most significant change to the Bankruptcy Code for the mortgage bankers in this room. And it's also the most controversial. The cram down proposal has created a firestorm of debate among academics, among advocates, and among legislators and other lawmakers. Critics contend that cram down will swamp an already overworked bankruptcy court system and thereby indefinitely delay resolution of the foreclosure crisis as bankruptcy judges work through an enormous backlog of undersecured loans. Still worse, critics argue that cram down will create an enormous moral hazard problem that rewards borrowers who took on too much debt and will encourage borrowers who, in fact, can repay unrestructured loans to seek bankruptcy relief to take advantage of just temporary conditions in the real estate market. And then perhaps the most powerful argument against cram down is that allowing cram down, some argue, will interfere with capital flow to the mortgage market. And specifically, the Mortgage Bankers Association has estimated that allowing judicial modification of home mortgages will result in an across-the-board increase in mortgage rates of not less than 2%. And as you can imagine, advocates of cram down have responses to each and every one of these criticisms. First, they argue that bankruptcy courts can handle the expected surge of Chapter 13 filings. They point to the change in the bankruptcy law that was effected in 2005 and the surge of filings that resulted in 2005, and argue that the bankruptcy courts with less resources were able to accommodate the surge of filings in 2005. They also argue that the workload in the bankruptcy courts are not. This is sort of an argument that I have to stop and reject before I make it. But there is an argument, and it's actually set out in Professor Morin's congressional oversight report, that the bulk of the work in Chapter 13 and in cram down is done not by the bankruptcy judges, but by the trustees and the lawyers for the parties. And that all the judges do is simply ratify what the parties propose. And that couldn't be farther from the truth, but that's one of the arguments that are made in the oversight panel report. And as a practitioner who goes to court all the time, I want to caution you for that's a canard. The better arguments, or the more powerful arguments against cram down, are that modification does not create mortgage losses that don't otherwise exist in the market. Instead, modification should be viewed as an alternative to foreclosure, and if the present value of the payments received under a sustainable modification is greater than what the lender would recover at foreclosure, then in fact lenders are better off. And if that proposition holds, that if cram down works the way its advocates say it will work, that lenders will receive more money from a non-consensual modification in bankruptcy, then that reality will be reflected in the interest rates charged for loans. The rates charged will not increase because lenders, in fact, will be receiving more money on account of defaulted loans. Again, Martin limited me to 20 minutes, and I'm going to try to stick to it. And we certainly don't have time to resolve the array of issues joined by the cram down event. But I think everyone here can at least agree that whether you're a proponent or a critic, mortgage modification is powerful medicine. And the question I want to look into just briefly this afternoon is whether cram down is the right medicine for the housing market. And that, of course, depends on how you define the illness, or how you diagnose the illness. Let's talk a little bit from the abstract world of economics. From the law and economics movement's perspective, the Chicago School perspective, mortgage modification should not be necessary. If the present value of payments received under a modified mortgage are greater than what's recovered at foreclosure, then the parties will bargain to an optimal compromise. There'll be voluntary workouts in the marketplace. But this isn't what's been happening. It's far from it. In 2008, there were 2.25 million foreclosures and another 1.3 million foreclosures expected in 2009. And the foreclosures, of course, contribute to declining housing prices, deteriorating communities, and failing banks. Make no mistake about it that the crisis in the financial sector is tied inextricably to the crisis in our housing markets. Home mortgages and the financial instruments tied to home mortgages are a major asset of banks and other financial institutions, and as home values fall and foreclosures spike, financial institutions see their balance sheets and their ability to supply credit deteriorate. And let's start at home. Let's look at the experience in our own Commonwealth. It's kind of fitting we're in the State House. Last year, in the response to the avalanche of foreclosures in the Commonwealth, the Massachusetts legislature enacted a 90-day right to cure, requiring lenders to provide borrowers at least 90 days of breathing room before foreclosing. The avowed purpose of the 90-day cure period was to provide borrowers and lenders with a real opportunity to explore the ways to reach a voluntary restructuring of sustainable loans and avoid foreclosure. According to Attorney General Martha Coakley, however, and I quote, "The results are dismal. Successful modifications continue to be a tiny fraction of the loans that are in foreclosure." And Attorney General Coakley ought to know. She's been a national leader in foreclosure mitigation, and she was one of the leading proponents of the 90-day cure period in the Commonwealth. In addition, Attorney General Coakley's insights are bolstered by some significant empirical research. Following the enactment of the 90-day cure period in Massachusetts, the number of loan modifications filed in the Registry of Deeds is minuscule when compared to the number of loans in foreclosure. Specifically, for the last quarter last year, the numbers are startling. 144 loan modifications were recorded in the Registry of Deeds compared to 4,721 foreclosure starts. Tellingly, not one of the recorded modifications reduced principal, and virtually none of the recorded modifications reduced monthly debt service payments. So in other words, the distressed loans are just as likely to default after modification as they were before modification. And this experience in Massachusetts has been replicated throughout the country. And one of the sources of the Congressional Oversight Panel's work that was published on Thursday is Alan White of Verapazio Law School, and he's done a lot of work on modifications and what's actually happening in the marketplace. So why isn't the real marketplace working like the economist laboratory? I mean, what's happening? Why isn't the market delivering voluntary modifications that avoid the substantial cost of foreclosure to both sides? And to me, what's singular about the very contentious debate about cram down is that both the proponents and the opponents agree fundamentally on the causes of the problem. They just disagree about the remedy. While the cure is heavily debated, there's a remarkable consensus about the causes of the problem. And let me tell you what they agree on. Both sides agree that the failure of the market to produce rational modifications which avoid foreclosure is a result of two principal causes: the securitization of home mortgages and the proliferation of junior liens covering borrowers' residences. In particular, both sides agree that privately securitized mortgages lie at the core of the current housing crisis. Despite representing just 15% of all outstanding mortgages, securitized mortgages account for more than 50% of foreclosure starts. And here's some more color on securitization. Over 2/3 of all the residential mortgages originated since 2001 are securitized. And for subprime and Alt-A loans, securitization is over 3/4 during this period, and in 2007 it was over 90%. The simple fact is that lenders who service loans held for their own portfolio, lenders like John Doherty, Kevin Bottomley, and Arthur Conley, have much greater success in avoiding foreclosure and arriving at sustainable mortgage modifications. The reality is that the loans underwritten by portfolio lenders like these gentlemen are much less likely to fall in default in the first place, and those lenders are much more likely to enter into modifications that don't default subsequently. Why? There's a very simple answer to this. The simple answer is that the ultimate owners of securitized loans, the holders of mortgage-backed securities, are not the persons who administer the loans and make the workout decisions. Instead, securitized loans are managed by third-party services and governed by pooling and servicing contracts that make little economic sense in the current crisis. First, most PSAs contain explicit and implicit legal barriers to modification. Sometimes modification is forbidden outright. Sometimes only the interest rates can be adjusted. Similarly, the number of loans in the pool that can be modified is often capped. Or servicers are required to purchase loans they modify at face value outstanding or even with premiums. And under the Trust Indenture Act and other applicable law, to rewrite private PSAs, typically requires unanimous consent of investors, especially if it would give services the right to reduce principal and interest payments. Finally, fear of litigation is chilling many loan modifications. Investors in mortgage-backed securities are typically tranched in a senior subordinate structure, and services may reasonably be concerned about investor lawsuits when modifications affect investor returns. There's a second feature to securitization that prevents modification in the marketplace. There are real practical impediments to modifying securitized loans. The way services are compensated under PSAs present significant practical obstacles to modification. Generally speaking, services typically take a percentage of the outstanding balance of the securitized mortgage pool or collections as a service fee. If the servicer modifies a loan in a way that reduces principal or monthly payments from the pool, then the services will also have a reduced income stream. Compounding matters, PSAs typically do not compensate services for the cost of negotiating and documenting modifications. By contrast, when a servicer forecloses, the service's compensation shifts to a cost-plus basis. In other words, third-party services, in contrast with portfolio lenders, have strong economic incentives to foreclose rather than modify distressed loans. And here I'd like to direct your attention to the Congressional Oversight Report. There's a lot of valuable material in there about the economic barriers, the incentives, the disincentives to modification of securitized loans. And the panel's report collects a lot of helpful research and analysis of these sometimes very technical contracts, and it really gets to the heart of the crisis. So for homework after this drill down session, I invite you to read it. We've talked about securitized mortgages. Let's talk about the other principal cause is junior mortgages, the proliferation of junior mortgages. There's broad consensus among both proponents and opponents of cram down that the proliferation of mortgages encumbering personal residences also significantly complicates the modification process. Senior mortgagees are reluctant to offer concessions because the benefits of these concessions will flow to junior mortgage holders. And out of the money, junior mortgagees often have quite a bit of hold-up power when refinancing is otherwise available. So that was a mouthful. That was sort of like the course you had in college from Plato to NATO. Let's start at the beginning. Where does this agreed-to record leave cram down? It's not clear to me, anyway, that cram down by itself will adequately deal with the problems caused by securitized mortgages and produce more voluntary modifications. To be sure, if the bill passes, homeowners will be able to threaten judicial modification in bankruptcy, but the mere threat of commencing a bankruptcy case won't override contractual prohibitions on non-judicial modification or change services' economic incentives to litigate in bankruptcy rather than to enter into voluntary out-of-court loan modifications. That's why Section 201 of the bill is an important first step in the right direction. Specifically, Section 2001 establishes a safe harbor for services from litigation if there's a default on the mortgage or a default is reasonably expected, the borrower occupies the home, and the servicer, quote, reasonably and in good faith, unquote, believes more money would be recovered through loan modification or workout than foreclosure. So number one, the bill establishes a safe harbor for litigation for third-party services. Second, it expressly overrides contractual limitations on modification contained in private purchase and servicing agreements. That being said, I still worry about the economic disincentives to engage, the economic disincentives for services to engage in voluntary modifications. The same way most PSAs contain cost-plus service agreements or fee agreements for foreclosure, they also can contain cost-plus fee provisions for bankruptcy litigation. In theory, at least, let's back up a little bit. In theory, the way cram down is intended to work is that borrowers and lenders will each recognize that there's risk in connection with litigating cram down in the bankruptcy court. And as a result, they strike reasonable compromises out of court. The problem with the PSAs is that unlike the actual holders of the mortgage-backed securities, the servicer might have an economic incentive. The incentive is the fees will be increased if there's litigation in the bankruptcy court notwithstanding from the holder's perspective and the borrower's perspective, as well as society's perspective, the best result is to have an out-of-court modification.
If I can just interject, I skipped over some of the details of the modification proposal that came out from the Obama administration and Treasury. But basically what they're proposing to do is to try to deal with precisely the issue by saying that a servicer who goes through a modification that meets the guidelines, presumably in lieu of a cram down that might otherwise take place, gets $1,000 for its trouble for doing it, and then $1,000 a year for several years thereafter that the loan remains out of default. The consumer also gets a bonus of $1,000 a year for remaining current. So there's a stick and there's a carrot in this latest concept that's proceeding on two different fronts. One being the Treasury and the FFIEC member modification program, and the stick being bankruptcy.
Right. And I'm not going to waste any more. I'm not going to take any more of your time, other than to conclude with the other problem, which was junior mortgages that we talked about. Cram down will help with junior mortgages. Out of the money, junior mortgages will be treated as unsecured claims in bankruptcy and discharged. So in other words, out of the money, second mortgagees will no longer be able to hold up refinancings and restructurings because they can be crammed down in the envelope of bankruptcy. So with that, I'll turn it over to Kevin.